Thank you very much. Welcome, everyone. Thank you for investing your time with us tonight. Sean, myself, and Tony are privileged to be here. And thank you for the bank for allowing us to present here. City National, it's an honor to be here. So we're here to talk about exiting, and within 2 years, whether it's 2 years, 3 years, 5 years, you're starting to think about your exit process, right? My name is Joe Szynski, and I am the owner and founder of brainSHARE Business Mentors. We help build a business that works without you. And that's what we're going to walk through a little bit today, because as you're building your business to get the most out of your valuation and the most money you want, who wants the most out of their company? Who doesn't? Who's not going to raise your hand no matter what? I see you. Okay, so we're going to talk a little bit about how to build the business. And as you're looking at exiting, the things you need to check on, things you need to make sure you've got, and the things that you need to do over the next 2 to 3 to 4 years to get ready to go. So I'll talk about building this, kind of your checkpoints. Sean will be talking about the process, and then Tony will be talking about making sure you don't give too much money to Uncle Sam, right? All right. So as you've built your business, when you start thinking about building your business, what do you start with? An idea? How about building a business is like building a house? Now what do you start with? Foundation. So foundation has 4 cornerstones. Okay? Cornerstone number 1 that you want to focus on is your goal. When are you going to sell your business? Now, this can change, as it probably has for anybody that's been in business. Oh, I want to do this. Has anyone started a business and their goals kind of changed over the years? Anybody? I know mine have. I've been planning my 5-year goal since I was 14. I've never hit it because it's always changed. Make sense? But set your goal. If you haven't read Built to Sell by John Warlow, I definitely highly recommend it. Who's read that? Built to Sell? Fantastic book. If you need book recommendations, see me afterwards and I'll give some to you. So set your goal. Next is your time allocations. As you start building this business, your time allocations need to change. When you start off, you're probably spending 50% on marketing sales at least, or 50% on trying to get funding, or 70% trying to get funding versus managing the business. Certain percentage on financials, making sure your accounting is in place. Right, Tim? You've gone through that. You allocate your time allocations change. Time is your most valuable asset. How you utilize it will determine the success of your life and your business. So what does that look like? What are your time allocations? And make sure you're consciously adjusting them. Standards, this is probably where you guys are all really good at right now. This is consistency in your product or service. Otherwise, you wouldn't be where you are today. And financials. Not only your hard numbers, as Tony's going to talk about, but your soft numbers. What are some of your soft numbers? Valuation would be a number. How about your soft numbers like leads, conversion rate, average dollar sale, number of transactions, lifetime value of a client? How many of you know those numbers? How many of you don't? How many's not going to raise your hand no matter what? If you don't, come see somebody here, because somebody here can help you out. And I'll be happy to help with that. That's you get into your financial numbers, your hard and your soft numbers. Hard numbers, Tony. Soft numbers, you better want to look at those. What are they? What are your ratios? How many of you have heard of Profit Sense, where you run your financials through a comparison? Anybody hear of Profit Sense? It's a comparison tool that you can run your financials through a comparison of other businesses in like industries, see where you're performing. If you're not aware of it, let us know. Foundation, boring, and then you get up to market positioning. This is where everybody has fun. Target market, target market, target market. The tighter your target, the hotter the flame. This is where you do your unique selling proposition, your guarantee, and this is where you start building your valuation, the value of your company. Sales training. If you have not put your people through sales training, you're missing an opportunity. And then you do your tactical and strategic marketing plans. You do tactical first because you want to make clarity in your messaging and then spend money on marketing. How many of you have spent money on marketing and never got your ROI? Come on, I know more of you than that because a lot of people spend a lot of money because there's not clarity in their marketing. Now you get to, once you get that market position defined, you get rid of that feast and famine scenario. How many of you have been through feast and famine? Okay, and this is where you get stability, and this is where you really start thinking about your goals, and now you're above that water line. You're above, you're not bobbing in the water with a snorkel. Now you're starting to swim. And we start systemizing everything. Save yourself time, energy, and money. And this is where your valuation will start creating. The more you're systemized, the more the value, the more the company's going to be worth a higher multiplier, right? And Sean will be talking about that a little bit more. And then we put our team together. Do you think you need a different team up here than down here? If you've systemized things, you need leadership. How many of you read 21 Irrefutable Laws of Leadership? Fantastic. It's awesome, isn't it? Yeah. Yep. You got. I mean, if you're not reading these books, you're missing out. You put your team together, and this is when you must move from a profit and loss focus to a valuation focus. Right, Tony? Sean? This makes sense. Now, wherever you're at right now in your business, you should look through each one of these and give yourself a grade on where you're at. If the foundation's not strong, what do you need to put in there? What do you need to fix? Give yourself a grade on each one of those modules. We put the team in place and we move from profit and loss to valuation and start prepping to exit out of the business. And that's where Sean and Tony come in to start getting that moving forward. Does this make sense? If one of these pieces is not strong, it will come out in your valuation. It will affect your multiple. Make sense? One more time. Yes. There we go. There we go. So if you want to get the most out of your business, make sure you've built it strong. The foundation is strong. Build it up. Get the highest valuation possible. And then bring in Sean. Sean. Now, right now. And Sean will take it from here.
All right. Thank you, Joe.
Thank you.
All right. And, well, so with that, since we got a whole audience here, I am going to take a selfie of everyone. Let's all smile for the camera. Social media later. All right. 3, 2, 1. Hey. All right, everyone. I will put this on LinkedIn later. So thank you guys. And Joe, amazing job. Guys here, I know almost everyone here, so I'm going to call on people. So be prepared. So if I say Leo, you got to respond. If I say Matthew, you got to give an answer. But the good thing is I brought a bunch of these limited edition ACG magazines. I know, right, Martin? Like, unless you're at Vegas at Intergrowth, you don't have one of these. Limited edition. Now, I know what you're thinking. What's the importance of this? The knowledge, the resources, and everything in here. But there's also page 49. Page 49 is the page of all pages. Now, only the people that win these magazines are going to see page 49. Unless they're nice and show you page 49, but they shouldn't. This is a prize just for the winners. All right. Page 49 kind of looks like this, just letting you guys know. So, okay, so Joe came in, talked about the foundation, talked about the systems, but what happens getting to the exit? So the exit itself, a little bit about myself. I am a mid-market investment banker focused on mergers, acquisitions, growth capital, and a little bit of secondaries. What does all that mean? That means I help with the transactions. So say you want to sell your company, say you want to raise capital for your company, lot of transactions that happen. I help with the processes. When I'm not doing that, I'm also an advisor at the SBDC with Edgar back there. Edgar, you guys, a lot of resources for startups. This guy right here, all free, all sponsored by your taxes. So definitely free because we don't actually see how that's linked. Now, quick question for the group here. If you wanted to do one of these transactions, such as sell your company, Why do you think you'd want to work with an investment banker? Experience. Martin, good. Right. Well, I thank you. But experience is definitely one of them. Steve. Valuation goes with the experience in that, but there's a couple more reasons that I'm really looking for. Anyone. Okay, so say an example, Peter and Matthew. Okay, Peter wants something from Matthew, Matthew wants something from Peter, but they don't get along. You bring in that person in the center to kind of work it out while they're arguing in their negotiation so that when that person leaves, they can still be friends. That's the investment banker. That's one of his roles. He comes in, he plays the evil guy on this side, the evil guy on that side. But at the end of the day, these two are probably going to have to work together for a year. There's that transition period. If the evil investment banker leaves, they can still have the relationship. Also, most people know investment bankers, they earn their living off the success of the transaction. So if I came to Matthew's this private equity guy. He sees 100 deals a month minimum. He knows that, well, this deal that I'm showing him is vetted by a guy that's going to live off the success of this or not. So he knows it's pre-screened. He knows it's well packaged. He knows it's not a waste of his time, right? He knows it fits his investment thesis. Now, quick question. What is an investment thesis? I'm going to throw a lot of vocabulary out there tonight, but it's vocabulary everyone here should know with their business. Leo, what do you think an investment thesis is? Guy who screens a lot of companies for Bay Angels.
I'm basing this off of my definition of investment thesis. Just what you're going to do with the money once you get it.
Okay, different. Not your finances, not like, give me this money, I'm going to put it into marketing, I'm going to put it, no, something else. Martin, you got a confused look on your face. It's like a what? No. You guys are thinking kind of over here, but I'll bring you back over here. An investment thesis, no, a theory, you already know. So investment thesis, so say Tony, he only invests in companies that are fintech companies that are geographically located in Silicon Valley, and his check size is $1 million. That's his investment thesis. If it fits that, he's interested in looking at it. If it doesn't fit that, he's not the right person to show it to, right? So private equity groups, VCs, all these people, they have their investment thesis that they've borrowed or raised money from their LPs and say, listen, you can trust me with your money. I'm going to invest it in this sector, this group. This is where I have experience. I'm an expert in. And they say, okay, go for it. And if the deal is in that pool, that investment thesis, they're good. If it's outside, sorry, you're a really great company, but we focus on fintech. We don't focus on ag tech. We focus on companies with EBITDA 5 to 10 million. We don't focus on companies that have EBITDA 30 million. If this person writes checks, say between 30 and 50 million, and your company's valued at 5, no reason in showing them. All right? If your company is valued at 100 million, no reason showing. Your company should be in that sweet spot that they like, and that way it benefits everyone, right? No one's time's wasted. So that's huge. So investment thesis. The investment banker will match you up with the network. I'm going a little bit over here. Sorry, going to bring you back here. Stay focused. I know I got 30 minutes. Raise your hand if you do have any questions during this time, though. I'll answer as we go along. So the investment banker, you might work with them because experience, they've gone through that rodeo. You got a brand name behind you. They know how to package your company, who to represent it to. They're that evil guy that will leave at the end of the day, and they're probably the most handsome person in the deal. So all those combined, very key. All right, I got 2 chuckles, so I got 2 people listening. All right, thank you. Yes, Joe in the back. You come to an event like this. Thank you for the softball. I think I should give you one of the prizes here. But really, you could ask around, find people that are in a similar sector as you that have gone through transactions, ask them their experience. Find that person that has the experience, that has that personality, because guess what? And I'm going to talk about it right now. You're going to be working with them probably 6 to 9 months. Okay? 6 to 9 months when your emotions are going like this. Like one day you're like, oh my God, everything's so good. Life's amazing. Next day is, oh God, I want to end. I've worked 7, 10 years for this. Nothing's happening. I can't reach. I can't do what I want. And then the next day, oh, we got another. Oh, we're good. So you're going to be like this, and you need that person to reel you in that you trust, that will tell you what's really happening and get you moving along this process, keeping all the steps going, keeping people moving along to that goal. So reasons to work with an investment banker. Now let's talk about that process that they'll take you through. Before you start working with them, you're working with Joe, you're working with these wealth managers, these tax advisors, all these people that are going to say, hey, your company, it's probably around this range. And you're looking at them going, okay, if my exit is that and this cushion, I can do this after. You have that. I mean, if you're going to go run a process, you don't want to be at the end surprised and go, wait, my company's worth 10 million where I thought it was worth 30. You want going in, okay, I'm probably going to get 10 million from this exit. My wealth advisor says this is the right number. My tax advisor has these plans for that amount. You've talked to all these professionals. It's all lined up. Yes, that's the amount I want. Yes, I want to run the process, sell my company now. So you have everything lined up. Now you're talking, that whatever it takes 1 to 3 years to get your company ready for the sale. Now you talk to the investment banker to sell it. Now the process they're going to run, we can break it into 3 steps. All right. Step number 1, gathering the information, the pre-marketing. Step number 2 is going to be marketing. Step number 3 is the due diligence. So pre-marketing, gathering all the information. What do you think happens then? It's in the name. Yes. All right. John, thank you. Good answer there. You know what? We got to get the group a little livelier. Matthew, you want to pass this back to the winner back there? Was it John? It's John. Am I allowed to look at page 49 here? You can look at page 49 wherever you want, but just don't show anyone else. Just show it. Yours. Always, keep it close, cover a little bit. Or, you could sell that online and retire, possibly, maybe. So getting the information in a data room. Okay, it's one area where everything of the company is going to be, literally everything you can think of for the company is going to be in that data room. I've seen people where they have transcripts to all the podcasts they've ever guested on be in a data room. But less granular than that, what do you think might go in it? Peter, what might go in a data room? Financials, great. Past 3 years, past 5 years, as far back, tax returns, all that. Next, what else could go in a data room? Steve, you moved your hand. Huh? Cap table. Great. Okay, what else? What else? Nikki. I heard IP. Yes. Any patents you have, your org chart, all that stuff, your team, your articles of incorporation, your marketing material, your information on your sales training, like anything you could think of, it's going in these piles. Environmental study, HR manual, you name it, it's going in there. You want this one location where when you get into due diligence, they just go, okay, I picked that. It moves fast. You want it all right there. So at the very beginning, when the market material is ready or getting made, the team, the research team with the investment banks just going through, okay, we know the financials, we know the org chart, we know the no red flags. You want it so there's no red flags. Any skeletons, you tell them at the very beginning. You don't want to be going down the road and someone's like, hey, wait, you got a lawsuit pending? You never told us that. Wait, who is this person on the cap table that you've never mentioned? Wait, who's founder number 2? What is it? You don't want any of those secrets coming out. All right, it's all prepared. So the data room, all this information there. What do you think, at the very beginning, what do you think the data in the data room is used for? I saw someone's eyes move up and to the right. Okay. Later on. How do people find out about this? Marketing materials. All right, so that data room, take that information for a blind profile and to create, you're going to create market materials such as a blind profile, such as a confidential information memorandum. You're also going to use that to develop what would be the investment thesis for the team to find all the buyers, right? You're looking at the company, you're looking at the financials, the sector, everything. Okay, we think we can sell the company for around this. It's got these specific, this specific sector, all this. This is the targeted buyers. We'll research it. We'll go out and we'll create this list. We're creating this blind profile to first send them. We're creating this confidential information memorandum, which is a summary of everything to send them after they sign an NDA. But quick question, even going back, the blind profile. Why do you think it's called a blind profile? I got a little smile. No. Harsh? Pretty much. It's maybe 1 or 2 pages. It has just enough information to get kind of whet your appetite to find out more about the company. Now, why do you think you don't want to just send them everything in the data room, send them the blind or the confidential information memorandum on day 1? Why do you want this little teaser, this blind profile? Darren. Okay, a little bit to build hype, but guess what? Darren, if you told everyone, hey, my company's for sale, what do you think is going to happen tomorrow? Atul.
Your valuation will go down.
Well, why would the valuation go down maybe?
You might be desperate.
I would say some other things. I would say people leaving, your employees are going to go, wait, we're for sale? My future is uncertain? Oh, I'm out of here. What about the vendors? Do you think they'd go, wait, what's going on here? Hey, pay me some of the money you owe me. What do you think about your competitors? What do you think they'll do? Harsh? Hey, Matthew, you're a top salesperson at your company. I hear the company's up for sale. Why don't you come over here? Give you a little sign-in bonus. You'll make your life good. Does that sound good to you?
Fantastic. Where do I sign?
All right. See, that's what I'm talking about. Your employees, they might get there's a lot that could happen that you don't know. So keeping it secret to the very, very last minute, probably a good thing, right? Another benefit of using an investment banker. You run your business, you keep things going because you're already working 80-hour weeks running it. They run the process, right? Because if you try to do both, if those numbers aren't like this and start going, or maybe even here during the process, that person, the end buyer, is going to go, yeah, that offer I gave you, yeah, that's also going in that direction as well, right? When you're selling everything, you got to keep those projections as true as possible. So we've created the market material. We've got the buyer list, that's been scraped from databases or compiled from databases, from personal connections, from Google, from you name it. You got this buyer list, that their list, that what they invest in, it fits your company. You got the blind profile. You're going out, you're marketing to them. They're seeing it. They're getting really interested. Like, oh my gosh, if I'm a strategic, we could just take this, roll it right in and grow. Or private equity. Oh, these numbers, these are fantastic. We're going to get a great return for our investors. We are interested in this company. We want this, but we need to find out more. Give us the confidential information memorandum. We'll give it to you. But you got to sign this non-disclosure agreement. Okay, we'll sign. We won't tell anyone. Please tell us. Sign it. Give them the confidential information memorandum. They're looking at it going, God, I really understand this company now. All right, I do have some more questions. I have some questions for the managers, the owners. Let's set up a couple of management meetings, or maybe I'll give an indication of interest and then get those management meetings. Quick question. What do you think might go in an indication of interest? An IOI. A lot of hands in the back there, but let's call on someone more up front here. Hey, Tony, what do you think might go in an IOI? Indication of interest. Great question. I guess the audience back there didn't hear, so I'll repeat the answer you just gave. Tony's answer was really thorough. His answer talked about, okay, it probably has what's the valuation range that you're given for this company? Do you have the funds for this company? What would be the closing time, maybe 60 days? A lot of information that then the seller could use to compare with the other offers that come in and go, okay, these guys are offering this much cash. They want to this much of an earnout. Tied to this, this one's this much cash and they want to roll over. Hey, this one, a lot of these terms I'm telling you are just kind of those financial terms for how the deal could be structured, whether it's cash, seller's note, earnout, rollover. We don't need to go in deep today. We don't have that much time because we need Tony to take the stage. But these are kind of different ways to get to a valuation that the seller and buyer would agree on. One's a little bit more risky. So cash, think of it this way. I give you cash, you have cash, but it's kind of risky for me because I don't know what's going to happen next. Are you going to stick around? Is there things I'm going to, but you probably don't want that earn out where I'm like, hey, I'll pay you more or I'll pay you money, but it's tied to if we make these sales next year or the year after that you've promised me, or, who knows, but it's that risk versus reward in the deal structure. All right, so we've got the IOIs out. We've renegotiated. Then we send out or get the LOIs, letter of intent. I know what you're saying. Why are there so many acronyms? It's just to make us sound smarter than we really are. It's true. It's really true. So now that we sound really smart, we come back to you. You find that one buyer you really like, right? Sign the LOI. You go into due diligence. What do you think could happen in due diligence, Fee? Exactly. No one has any idea what could happen in due diligence. Great answer. Well, as the buyer, I want to check out what the company's really made. I mean, you've told me all this stuff. I'm like, oh my gosh, you told me this is the most amazing company. Now let me bring in my accountant, check it out. Let me bring in my lawyer, check it out. Let me bring in my IT team, check it out. Let me bring in the people to make sure what was said is true. So I have confidence in this money, this offer I'm presenting, right? And you're sitting there sweating going, oh my God, I hope they don't find these skeletons. But don't worry, they were all already discovered. Robert, all right. But what I'm saying is, so we go into due diligence, everything that's been said gets checked, and then finally you close. Definitive agreement signed, everything gets put in escrow or transfer in that. And then what you thought from that day one when you're talking to Joe setting it up, when you're talking to your Darren the wealth advisor or the tax advisor, all that of, hey, you're going to get this much in the exit and then you can go hang out in Puerto Rico on the beach. Well, this whole time, 6 to 9 months have passed and now you're at the beach, hopefully. Oh, let's give a round of applause for sitting on the beach, right? Now that's the whole process. So think of it as the pre-marketing, the marketing, and the due diligence or a negotiation or however you like to call that part. Or you could even break it further into, data collection, pre-marketing, marketing negotiation, due diligence. It depends how you break it up, but it's a pretty formulaic step-by-step process of taking the information, creating the story, get in front of the eyeballs of the people that like that story, have them want to invest the story, and then keep the story for themselves. With that, is there any questions before? Okay, we got Matthew, then Joe. Matthew.
Somebody's 5 years out, 2 years out. What can they do before going to you or Joe to help increase their value to get more money? Are there tips, tricks?
Great question. Well, first off, there's a lot of things. Joe talked about some metrics tracking, right? Are your numbers similar to the competition out there? Your lifetime value of customers, your cost of acquiring a customer, your net promoter score, your annual recurring revenue, all these numbers, how do they stack up with everyone else, right? How's that team culture? Here's the big one, how are the processes? So I'm just going to pick someone. Peter, all right. Question for you. What company do you think is more valuable? You're the CEO, right? Every day you come into work. Every day Matthew comes to you and asks you questions. You make the decisions. And then Leo knocks on your door every 5 seconds. You're there super late at night, sweating. You're just, I haven't had a vacation in 5 years. I work 7 days a week, 9 to night, terrible. Or Dalton's company. Dalton goes on vacation 2-3 weeks. He checks in. Everything's running on its own. Everyone knows what they're supposed to do. Once in a while, Dalton comes in and the employees are actually annoyed by Dalton. They're like, hey, we got this. We're growing. We're hitting all the milestones. We're doing what we're supposed to do. Nikki comes by. Both companies, same sector. Both companies, same size. Both companies, everything is pretty similar, but the processes, everything, how it's running, completely different. Nikki, which company would you want to buy? Exactly, Dalton. So Dalton's company that runs without him is the one that would have the highest valuation, right? Going to market, easiest to tuck in, easiest to operate. Everything, all the systems are in place. So as early as possible, if you're thinking about, okay, what are the processes that need to be run? How can I create this so it's just one more or less manual that can be handed over to someone? They can take and look at it, go, okay, over time, lifetime value of customers going up, cost of acquiring customers going down. These are the things they implemented. Okay, this is what the sales funnels look like. This is what has been tried. This is the mark. Everything, every step by step, where it's predictable. This much goes in, this much comes out. That's what you're wanting. You're wanting that when you hand it to the investor, you've de-risked their investment for them. And that has the highest valuations? So quick question we got two twins here. All right, Alex and Eric. Question for you. One of you guys are going to get this right. All right. So Alex's company has 10 clients. Okay. Eric's company has 500 clients, right? Alex's clients, one of them makes 30% of their sales. Eric's clients, none of them make more than 1%. Who do you think, which company is going to get the better valuation? Exactly. Atul, why?
Less dependent on small number of customers or one customer.
Customer concentration. If that one customer is lost, the sales just went like that. Eric can lose a huge chunk of his customers. They're still good. Not a problem. Right? So there's things like that while looking at the company and go, okay, think of it this way. This one sentence itself, I think, really summarizes how investors will look at things. They'll look at it as going, what's the probability I'm going to get my money back at a multiple I'm happy with, right? If the probability is very high, the multiple can be down, low. If the probability is very low, the multiple has to be very high. And then somewhere in there, you're trying to figure it out, right? So probability is high and it's got a decent multiple. That company is going to be so much more valuable. That probability is low with the high multiple, right? So just factor that in and start thinking, okay, is this company here? Is the probability high of all these things that I'm predicting? Okay. Is there that growth? Okay. Valuation super high. That company, is the probability that I'm going to get these, what they're saying? The probability is pretty low. Okay. And multiple is the same as the other, but since the probability is low, I got to discount the value I'm giving it to it. Does that make sense to everyone? All right. With that, time for one more question, I'd say, before Tony takes over. Maybe two questions. Okay, we got Nikki and Eamon. So you only pick one of the LOIs, right? So oh, you're saying like in due diligence and that. So very interesting question. And this is also going back to the whole pat on the back, why you need a good investment banker. A lot of people will get these LOIs and they've never done due diligence on who gave it to them, right? So I could go, hey, Tim, you're a company of yours. Check out this LOI. Highest valuation of anyone there. You're going to pick me, right? And then Tim's like, hey, Sean kind of embezzles money, and or we'll say Tim there, or some other than this Sean. But no due diligence, no background check has been given on the guy that gave the LOI. 6 weeks in or however long, you go, Sean never had any money to begin with. He was going to raise money on this LOI he gave me. He completely wasted my time. And then Matthew, who is a private equity group sitting on $1 billion, he's like, yeah, the offer I gave, I don't know why Tim never looked at it. It was a real offer. I could have paid cash the next day for it. Like, we knew what we were getting into. We bought a similar business. We knew we were going to roll this up. Everything was set. I don't get why they didn't pick us. But guess what? No due diligence was done on who gave the LOI. No background. And that's huge. There's a lot of other reasons why those LOIs, maybe the interest rates change and the person getting is like, hey, it doesn't make sense now. The debt component we're going to use with the interest rate. There's a lot of reasons why things might fail, but a good part was due diligence done on who offered the LOI. Next question. Great question. Okay, so the question was, when the red flags pop up at the very beginning of the screen, and so going back to working with clients that you have a high conviction there will be a successful exit, because you don't want to work with someone 6 or 9 months if you don't think you're going to get that payday at the end. So at the very beginning, normally you're spending 1 or 2 weeks diving into their not complete, but semi-formed data room and asking for more information so that you can go to them and go, listen, I'd like to work with you, but my fee is this, the success percentage, we're thinking we can get around this. So we'll charge you this much retainer, this much of a success on that. At the very beginning, when you're looking at it, you're going, God, this customer concentration, God, this doesn't look good. You know what? Really? We're kind of guessing the market will give you this right now. Are you okay with that? No, I need this. You need that. We really don't feel we can. But if you wait a year, you talk to Joe, you get some of this stuff cleaned up, here's some suggestions, then come back, then let's talk. Do they do that? Take a guess. All right, that's a magazine right there. All right, Matthew, you want to pass this back? Normally, they go to their friend who knows a friend that knows somebody that's just like, yeah, we could sell you for that. Just pay us this much money. We'll run a process. And then, 6 months, 9 months later, they call us up and like, hey, can you guys try again? And we're like, well, you already signed an agreement with them and they have a 24-month tail period and you need to give us all the buyers they went out to. Oh, that's a pretty healthy list. Yeah, you guys, good luck. So you guys put yourself in bad situations, just let you know, with who you pick because of contracts, tail periods, all this other stuff. But I think that's for another day. I think I actually went over my time. So with that, Tony, are you ready?
Ready as ever.
All right, let's bring you up here. Yeah.
Nice job, man.
Thank you, sir.
All right. Wait, does this? Oh, this works? Okay. Can everyone hear me? Keep it close. All right. Sounds good. Welcome everyone. My name's Tony, the CPA dude. Very not your typical CPA, pretty laid back, but hopefully can bring some ideas for everyone here for when you exit your company. Got some bad news for one of the strategies we'll tell you tonight. 2 years may not be enough time, so you might have to hold on tight for that. But I just want to start off with the team aspect. So the team is crucial, not only from who's running your company, but also from the finance and the CPA tax side. So a lot of folks that we work with, it's very reactive. So the financials, the ratios, everything's usually a mess. So when you do ask for profit and loss statements, balance sheets, everyone's usually scrambling. So you kind of need, a fractional CFO, kind of like Steve here, right? So you need someone to help make sure everything's flowing and going. And then as part of the process too, you need to uncover kind of like the dead skeletons within your business. So when I used to work at Uber and DoorDash, you'd think they're bigger companies that are well established. It's actually not that pretty on the inside. It's actually just 5 people just trying to keep the ship alive. So you actually uncover a lot of bad things back there. So unfiled sales tax returns, that's very big. What kind of, what reserves are put on for not filing certain positions. So really unraveling that would be big for everyone, just as you're getting prepped up, ready, getting this all shiny to, sell out. So those are just a couple main items that I want to hit on just from as you're still operating your business, getting it cleaned up, be more reactive. Like as business owners, you just want to see, hey, how are you actually doing? Like if you go hit up your finance person, your bookkeeper, your CFO, like could they produce it for you real time? If not, you might want to reevaluate, actually see how everything's going and get someone new in board here. You need financial health. So those are just some small items just to clean up as you're prepping for your company. And then just kind of 3 main things I want to touch on tonight from taxes. So, you got, Sean here, you got Joe here, got you ready, brought you to glory land. You got 10 million bucks. Who wants all that money though? Uncle Sam, most hated guy in the room, but not here. But so he's going to want, we're all in California here. So he's probably going to take 40, 50% federal and state. So do you really want to lose $4 to $5 million here? I don't, unless someone loves paying taxes, funding, who knows what. But I think most people would say that they don't want to pay that much in tax. So what can you actually do to mitigate your taxes here? So I kind of got 3 main items for us tonight. The first one, just want to talk about is the 1202 exclusion. So this is the qualified small business stock. And this is where you do have to wait 5 years if you're not a corporation. So first, you need to be a corporation. If not, time to go back to the drawing board, possibly you're an LLC. That's often common that we see in the startup world. You're an LLC, but you need to change your tax selection to be a C Corp. So this starts the clock, right? You need to be a C Corp and you need to issue your stock. That stock needs to be issued to you founders, whoever it is, within, that first initial issuance, and you have to hold on to for 5 years. So depending on where your timeline starts, make sure you've exercised it. It's all tidied and everything. The reason why is because you can either get the greater of $10 million or 10x of your stock basis. So that way, once your exit is out, all of this is going to be excluded. A lot more quirks and details into this, but just kind of throw in some seeds into everyone's head. We can always dive into more details later, but at least you're aware that this exclusion exists. So a lot of times, just basic elementary stuff we want to present to everyone, put the seeds in, keep it in the back of your head. And then when you're ready to go, it's probably been blooming, flowering, you're ready to roll. So that's your 1202 exclusion, potential 10 million exclusion or even more on that part. And then the second one that we want to talk about is your opportunity zones. So what is an opportunity zone? Opportunity zone, more or less, lack of better words, a bad area that the census has designated. Like you can invest into these opportunity zones and you'll get a tax deferral of the big gain that you've had. Originally came out in 2018 when tax reform happened. I'm curious when it's going to be renewed again because the original clause was that you could defer everything up until 2026. With 5 years hold, you could get a 5% erase of your capital gain. If not, you held for 7 years, you could get 10%. But even if you started in 2 years, now it's going to be 2024, and then you're not really going to get that benefit of the 5% or 10% because there's not time frame on that. So generally, this is probably going to get renewed 2025, 2026. Something else is going to happen in that space. So just stay tuned on that. Nothing came out, this past week of the Inflation Reduction Act. So that's your opportunity zone. What is that? What happens? Why would you want to even do that? So you're going to invest in this property here. You're going to most likely have appreciation. You're going to get your rent. You're going to be more or less, if you sold your company, you'd be sitting on a pretty decent island. I would hope collecting your rent and then deferring your taxes up until the meantime, hopefully getting, a little bit loss a gain excluded also. So that's your opportunity zone, kind of like another strategy for you to implement. And then kind of the biggest one here and kind of like going back to the team aspect. So kind of like there's different levels of CPAs, right? So there's kind of like more your general practitioners, you got your super specialists, kind of like your doctors, right? You got a PCP, but then you got your neurosurgeon, right? I'm by no means a neurosurgeon. I'm just, your PCP here, able to link you to the right parties. And which kind of leads into just the third strategy that we have. We have actually strategic partner who helps us with big capital gain sales. And their fancy name for this is called the Phoenix. So what this Phoenix strategy is that you got a big capital gain sale. And how do you wash this away? If you don't want to do a 1202 exclusion, you don't want to, invest in opportunity zones or any property, what can you do? So they've developed this where big capital gain, 10 million bucks, right? Now, what do? You pay 4 million Uncle Sam? Most likely not. You're going to go find every way in your means to avoid that. And how do you avoid it legally? By finding the right parties to connect it to. So what this is that you're going to sell your company. They have partners with just big Wall Street folks. They're able to get warrants. So you're buying these warrants with this big pool of cash you're going. These warrants happen to expire in the near term future, less than a year now. So you have enough time to wash away your capital gains. You're going to get a fat tax deduction. So you have a $10 million gain. You're going to have a $10 million investment in the warrants. Whoops, you forgot to exercise them all. Now you just have $10 million of losses. So now your Phoenix, turned into dust. And now the second action part of it is actually rising back up, right? So, hey, you just spent, $10 million, $9 million. How are you going to actually get that money back, right? So as part of the transaction, it's supposed to come back. They will structure it where you have a new C Corp. This C Corp generally just turns into a family office now. So this family office, how do you live within the family office? You want a new house, you want probably a Lamborghini, a new car, live your best life, right? Maybe buy an island. I heard islands go for $500,000 now, apparently. So they will structure it back out where you get $9 million back from a 10. So you need to reserve some for taxes, some for the transaction deal, but this is really just reserved. It's a really long strategy to do. It takes a lot from, having enough economic substance to actually make this happen. It can't just be a flyby overnight. A lot of parties involved into it, but, really getting, if we're talking 2 years out here, this is kind of the time to start thinking about this, having these conversations to line up the right folks in order to wash away your capital gain here. So kind of between these three main items, where we're going to exclude it, if you're more traditional tech startup, that's a lot that we work with personally, within real estate too, having everything in an opportunity zone. And then obviously, more or less you rob Peter, pay Paul. You keep on doing that with all your cost segregation and your bonus depreciation. And then lastly, this phoenix here that rises back up and washes away from your capital gains. So those are kind of the main three things I want to keep, more basic for everyone. Taxes as dry as it can be already. So try to keep it somewhat interesting. But yeah, other than that, happy to take any questions. And then if anyone has, further items to discuss, everyone's tax situation is always different. So you can always discuss further on that note. Yes, sir.
I want to make a comment. There's a big difference between accountants. So interview before hiring them. I've personally fired 5 accountants, and over the last 13 years, I've recommended firing them at least 20 times. So and sometimes you can outgrow your accountant. Not all accountants are the same. So interview them thoroughly because it's a very tight relationship. It really is. That's look, accountant, banker, these are two your tightest relationships. Business, investment banker. So make sure you're doing a thorough job of interviewing your accountant.
Yeah, I'd say like a lot of accountants are just, just the nature of the business. We should talk about this later too, of changing it. But the nature of the business is you're just super reactive. Everyone comes to them during, January, February, March, April, just wants to get it done. And it's just a high volume business. I think it's just the nature, and it's hard to change that, but you just need to find the right specialists that just come in and, hey, this is the one thing that this person does is just wash away capital gains. So that's a very good point there. Just even from just being, your general primary CPA, it's like, hey, does your CPA even know of these type of deals to even happen, right? So, me 3 years ago, would have never known, it's just meeting and getting out and finding the right people. Cause then once you have clients in the same space, like, wait a second, what can you do to wash away capital gains? You're going to go search because, to provide a value, you got to find a way to mitigate the taxes. Great.
I'm totally serious because you go through there's specialists, so in your industry, maybe you want to look for a specialist in that industry, but there's a process to go. Everything in the process is, I'm a little engineer, everything, keep it simple. There's a process to go through the interview, go through the process, and it's like that. You go to a doctor, you're not going to go to a doctor and see. They're all different.
Oh yeah. Like as the specialty comes, yeah, definitely want to find someone specific to your transaction, right? So like if it's, big, selling of your business, or it could be completely different. Maybe someone went to the moon on crypto. There's crypto specialists out there. Yep. There's real estate specialists out there.
Just do mom-and-pop taxes up to CFOs, controllers, and a Fortune 50 company. And it's a grayscale. It's not that. So you got to figure out where you want. I had one accountant I talked about some C Corp stuff, and they're like, oh, well, we really don't do C Corps because I asked what the percentage was. There's no C Corps. They're not familiar with it. Don't apply that.
Yeah, if it's definitely probably the family CPA, probably that's a sign. If it's the mom or dad CPA, you probably need to kind of look other. Nothing against them. They're probably the kindest people in the world, but just don't know enough.
Just taxes, that's okay. But if it's taxes and some CFO type services of actually looking at your financials to help run the business, it's a different animal.
Yeah. Yep. Bookkeepers, tax preparers, H&R Block, my best friends. Yeah, but it's kind of just, I think, bad education on like CPAs and finance people's side of items. They just don't really distinguish, hey, what does a bookkeeper do versus what does a CPA do versus what's a controller do versus what a CFO does, right? These are all different roles, right? Like a bookkeeper, right now you could probably go through QuickBooks, a 2-day, 8-hour training, and you're a licensed QuickBooks advisor, actually. So it's, unravel your worms out there. It's not that hard to become a bookkeeper, and not sure how much, everyone scrolls social media here, but there's a lot of, maybe my targeted ads are really bad. Just, hey, become a bookkeeper, earn 6 figures in a year. So definitely want to watch out for who's a bookkeeper, who's a tax preparer, and EA even. EAs are great too, but are they specialized in your specific part? Oh, enrolled agent. Yeah. So enrolled agent, it's a smaller, I'd say it's very hyper-focused tax professional, designation by the IRS. So if you don't get a CPA, you can get an EA to sign off on tax returns. Yep. Oh, there we go. All right. I was like, oh, is that the Snoopy? Oh, no, yeah. No, any other questions? Is anyone exiting in the next, does anyone see themselves exiting in the next couple of years? Yep. Yeah. 3 more years, right? Maybe 5 more. Yeah. See where you're at then, right? Yeah. But something to always have a conversation, always, revive a dead soul. Like, hey, why didn't we start from the beginning? Ask your legal guy too. Get them in the door.
One of the other things I see a lot of is, as the business owner, you should be defining your chart of accounts and validating with the accountant. The accountant will just kind of typically put together the best he knows, but you know your business better than anybody. If you're not putting together your chart of accounts to run the business, you're in control. And that's where you get a great accountant like CPA.
Yeah, no, that's very true too. Always, like when we go back to business owners, who knows the expenses the best? When should you recognize revenue? Another big thing too. So, and then I guess one other thing just to think about this whole thing as you're going through your bookkeeping as just the foundation of, from a finance tax side, is this missing, and something to hark on too with, the new attempt to hire 87,000 IRS agents, really not only for your due diligence side, but are your invoices there? Are your receipts there? These are such basic items, but even back when I was pulling invoices at Uber, like receipts were missing. Like, a well-established company doesn't even have the best processes. So, smaller mom and pop shops, could that be a missing area too? Okay, great. Anyone else?
How early on should a startup get their account?
I would say I'd probably go 6 months before. Find the right person, start the right interview process if you really want that person there. Because I think that right, CPA or, fractional CFO, I think they should be in ready to go once you flip on the lights, and even before then. Great.
I just wanted to leave. Tony, come up here. Okay, so for the audience, we got the before the exit, during the exit, after the exit. Any last minute questions before we wrap this up for just networking? And there's a couple bottles of wine left and some food that got to be finished here. Just, we don't want to leave anything for City National Bank, the sponsor. But any last minute questions before we have them all come up one last time and say a thank you for, yes, Tino.
So, what's that song where the needle is connected to the elbow or whatever?
Okay.
And so
You
the whole
might.
planning process should be.
Amal, stay up here.
I'm a big fan of knowing your goals and then planning to execute to the goal. I mean, there's a reason why we're an Ohio-based Delaware Seacoast.
Yep.
And so but getting that consolidated strategic view is not necessarily obvious.
No, most people, well, everyone, we don't know what we don't know. I mean, I could go to everyone in this room and everyone here could teach me a lot of things. Ask Michelle, my wife over there. She'll tell you firsthand experience that I don't know much of anything. So
So we'll ask Michelle about everything. Great. Okay. That's the process. Ask Michelle.
exactly. Bring in people early on, get the right advisors, get the right mentors, get the right team. It'll pay off dividends.
But the whole thing about process, So is there that process? Is it built yourself?
Built to Sell is not really. I mean, if you want some of the best overall books, Traction by Gino Bookman, Scaling Up of Vern Harnish with the BHAG. So there's lots of different spaces. So it really depends overall where you want to go. I put together what's called a roadmap, and it's a 24-month, week by week plan of where you are today and what you need to do to get there. It includes all of this, but it really depends. You know your business better than anybody else, so you have got to help define that on the specifics. You know, there's lots of frames out there, but you've got to put the paint, the wood, the bricks, everything in there.
I know a lot, but I know I don't know everything. And that's what's good.
Hey, I've got 3 coaches, and my wife's one of them.
I got a stack of magazines here. So any last questions so I can hand these out? Too heavy for my back.
And I've got a couple of books here. Anyone? This is the best-selling book, BrainShare, available on Barnes & Noble and Amazon.
All right. Yes.
Top 3 books to read or whatever. You have your top 3, or do you guys have a top 3?
we did a whole webinar on that.
Yeah. I mean, for us, there's a couple of videos on this guy's website or YouTube channel.
Mm-hmm.
Check it out. We did a book review on a lot of stuff. If we think the information in it is legit or total BS. And there's a couple books out there that a lot of people reference that are like, that's not reality.
Right.
And then other books are like, you got to double click and dive deeper into that. So subscribe to Joe's YouTube channel and really go into it. Tony, do you have some?
Oh, I only read text notes. I read nothing else in life.
Next question. Guys, page 49 is pretty awesome.
It is pretty awesome.
Yeah.
I want to thank you all for coming here. Please come on. So thank you all for investing your time with us, because time is our most valuable asset.
What do you want me to do? Thank you. There's more food, more wine. I filled up the water. And enjoy, please. That's it.